Imagine walking into a store with cash in your hand, real money. You're ready to buy. The price is fair, the product is solid, and yet the seller looks at you and says no. Not because your money isn't enough, not because you're untrustworthy, but because they're scared. That's what just happened in the market. A simple $200 offer was turned down, quietly, no headlines, no breaking news alert, just a rejection buried deep inside the system most people never look at. And that's exactly why it matters. Because when markets start rejecting money, not risky money, not shady money, but clean, straightforward offers, it means something underneath is no longer working the way it should. Let me be very clear. This isn't about $200. This isn't about one trade. This is about confidence. And confidence is the only thing holding the financial system together. Markets don't run on numbers. They run on belief. Belief that buyers will show up. Belief that sellers will honor prices. Belief that liquidity will always be there when you need it. The moment that belief cracks, everything changes. When an offer gets rejected, the first instinct is to shrug it off. No big deal, people say. It happens all the time. And most of the time, that's true. But this wasn't normal. This wasn't a bad price. This wasn't a technical error. This was hesitation. And hesitation in a market that's supposed to be liquid is dangerous. Because liquidity is trust in motion. It's the assumption that money can move freely, instantly, without friction. The moment offers stop flowing smoothly, the system starts to stiffen. Spreads widen, volatility creeps in. Participants pull back. And when participants pull back, fear takes their place. Here's what most people don't understand. Markets rarely collapse loudly, they weaken quietly. Slowly, one rejected offer at a time. One small anomaly that nobody thinks is worth paying attention to. Until suddenly, everyone is paying attention. Think back to every major financial crisis. There was always a moment before the panic. A moment when something small broke, and the people who noticed it were ignored. A failed auction, a frozen fund, a trade that didn't clear when it should have. Those moments don't look dramatic in real time. They look boring, technical, easy to dismiss, but they're not random, they're signals. And this one is flashing red. Because if a market is healthy, it wants your money. It competes for it. It absorbs it. It welcomes it. When a market starts turning money away, it's telling you it doesn't know how to price risk anymore. And when price discovery breaks, fear takes over. Ask yourself this. Why would anyone reject a fair offer unless they're unsure what that asset is really worth? Unless they're worried that accepting it today could be a mistake tomorrow? That uncertainty spreads fast. One trader hesitates. Another notices. Liquidity providers widen their margins. Buyers step back. Sellers demand more protection. And suddenly, the smooth machine everyone trusted starts grinding instead of flowing. This is how panic begins, not with crashes, but with doubt. The scary part isn't the rejection itself, it's what it reveals. A system that's no longer confident enough to say yes, because once markets lose confidence, they don't regain it easily. Trust once broken demands a premium, and that premium shows up everywhere. Higher rates, lower prices, tighter conditions. All of it starts small. $200 is nothing. But the message behind the rejection is everything. It tells us that participants are no longer thinking about opportunity. They're thinking about survival. And when survival becomes the priority, risk assets suffer, liquidity dries up, and the rules change without warning. This is why seasoned investors don't watch headlines. They watch behavior. They watch what markets do when no one is looking. And right now, the behavior is off. Money knocked on the door stayed closed. That's not normal. That's a warning. Most people won't notice this until it's too late because the system is designed to look calm on the surface. Screens are still green and red. Prices still move, trades still happen. Everything appears normal if you don't know where to look. But underneath, the tone has changed. When money gets cautious, it doesn't announce itself. It hesitates, it waits. It tests the water with small offers. And when those offers get turned away, money doesn't argue. It leaves. That's the part no one talks about. Capital is emotional. It has memory. When it feels unwelcome, it remembers. And once it steps back, it doesn't rush to return. The rejection of a small offer sends a message far beyond the size of the trade. It tells participants that liquidity is selective now. That certainty has a price, that the old assumptions no longer apply. This is how markets transition from confidence to caution. At first, it's subtle. Risk managers tighten limits. Market makers reduce size. Institutions shift from aggressive positioning to defensive posture. None of this makes headlines, but it changes the entire environment. Suddenly, deals that used to clear instantly require justification. Trades that once felt routine now feel exposed. Everyone starts asking the same question in different ways. What if I'm wrong? And once that question enters the room, it never leaves. Because fear doesn't need a reason to grow. It only needs uncertainty. The dangerous thing about uncertainty is that it feeds on itself. The less clarity there is, the more people protect themselves. The more they protect themselves, the less liquidity exists. The less liquidity exists, the more volatile prices become. It's a feedback loop, and it accelerates faster than most people expect. This is why small rejections matter more than big ones. Big crashes force explanations. Small anomalies get ignored. But small anomalies are where stress reveals itself first. Think of it like a crack in a dam. No one panics when the first drop of water appears. They panic when the wall finally gives way. But by then, the outcome is already locked in. Markets work the same way. The people closest to the system feel it first. They sense the hesitation. They notice when bids don't show up like they used to. They see when offers sit unanswered longer than they should. And they adjust quietly. They don't announce panic. They prepare for it. That preparation shows up as less risk-taking, less leverage, less willingness to absorb shocks. Which means when something does go wrong, and something always does, there's no cushion left. That's when small problems become systemic ones. The rejection of a modest offer is not about dollars. It's about trust between participants. Trust that prices are fair. Trust that markets will function under pressure. Trust that exits will be available when needed. Once that trust erodes, even slightly, behavior changes everywhere at once. And here's the part that should really concern you. Retail investors are always the last to know, not because they're less intelligent, but because they're shown the cleanest version of the story. By the time uncertainty reaches the surface, the smart money has already repositioned. That repositioning is happening now. You can feel it in the language. People stop talking about growth and start talking about resilience. They stop chasing upside and start protecting downside. Optimism gets replaced by phrases like just in case and wait and see. Those are not bullish words. They are defensive ones. When markets are confident, they lean forward. When they're unsure, they lean back. And right now, the posture has shifted. The system is no longer eager, it's cautious. And cautious systems don't absorb shocks well. All it takes is one unexpected event, one policy mistake, one liquidity squeeze, one piece of bad news arriving at the wrong time. In a confident market, those things get shrugged off. In a cautious market, they cascade. That's why this moment matters. Not because something has already broken, but because the conditions for breakage are forming. The safety margins are thinner. The tolerance for risk is lower. The willingness to step in and stabilize is weaker. And when offers start getting rejected, even small ones, it tells you that participants would rather miss opportunity than absorb uncertainty. That mindset spreads fast. It moves from desks to firms, from firms to sectors, from sectors to the entire system. And once it's everywhere, reversing it becomes incredibly difficult. Because confidence can disappear overnight, but it takes a long time to rebuild. Money needs to believe the ground beneath it is solid. The moment that belief wavers, it starts looking for exits. Quietly, methodically, without emotion, until the emotion shows up all at once. That's how panic really begins. By the time the average person realizes what's happening, the market has already made its decision. That's the uncomfortable truth. Markets don't wait for permission. They don't explain themselves. They move based on incentives, fear, and the collective behavior of people who are trying to protect capital, not make headlines. And right now, protection is winning. When money stops chasing returns and starts prioritizing safety, the entire landscape shifts. Prices don't reflect optimism anymore. They reflect caution. Volatility isn't driven by excitement, but by hesitation. Every move feels heavier. Every decision feels slower. That's not an accident. That's a system under stress. What makes this moment especially dangerous is how normal it still looks. There's no obvious collapse, no dramatic failure, just subtle signals that tell a very different story, if you know how to read them. A rejected offer, a delayed execution, a bid that should have been filled, but wasn't. These are the whispers before the scream. Because once liquidity becomes conditional, everything else becomes fragile. Assets don't trade on fundamentals anymore. They trade on access, on who can move first, on who gets out before everyone else realizes there's a problem. And when that realization hits, it hits all at once. That's when you see gaps instead of gradual moves. That's when prices jump past levels instead of trading through them. That's when safeguards fail because they were designed for normal conditions, not stressed ones. The system assumes cooperation. It assumes participants will show up. It assumes markets will clear. But assumptions are only valid until they're tested. The rejection of even a small offer is a test. And the system didn't pass it cleanly. What follows next is rarely obvious, but it's always consistent. Participants become reactive instead of proactive. Decisions get shorter term. Conviction weakens. The question shifts from how much can I make to how quickly can I get out. That shift changes everything. Because markets are forward-looking, but fear is faster than logic. Once fear enters the equation, rational pricing takes a back seat. People don't wait for confirmation, they act on instinct. And instinct says one thing above all else: don't be last. That's why liquidity disappears exactly when it's needed most. Everyone wants to sell to someone else. No one wants to be the buyer who catches the falling knife. So bids vanish, offers stack up, and price becomes whatever someone is willing to accept just to escape. That's not a crash, that's a vacuum. And vacuums don't resolve gently. This is where the illusion of stability breaks, where people realize that markets aren't guarantees, they're agreements. Agreements that only hold as long as participants believe in them. Once belief erodes, force takes over. Central banks can add liquidity, but they can't force confidence. Regulators can step in, but they can't make people take risk. Policy tools work best when markets are already functioning, not when they're frozen by doubt. And doubt is exactly what's spreading. The rejection of money sends a psychological signal that travels faster than any headline. It tells insiders that something isn't right, that pricing models may be wrong, that risks may be underappreciated. So they act quietly, efficiently, without emotion. They reduce exposure, they raise cash. They prepare for scenarios they don't talk about publicly. And that preparation creates the very conditions everyone fears. This is the paradox of markets. Defensive behavior is rational on an individual level, but destructive on a systemic one. When everyone protects themselves at the same time, the system loses its ability to absorb shocks. That's when accidents become disasters. The tragedy is that none of this feels dramatic while it's happening. It feels responsible, conservative, smart, until the moment arrives when everyone realizes the exits are narrower than they thought. That's when panic stops being theoretical, it becomes visible. And once panic is visible, it feeds itself. Prices falling validate fear. Fear drives more selling. Selling drains liquidity. Drained liquidity accelerates price declines. The cycle closes. This is why early signals matter, not because they predict exact outcomes, but because they reveal changes in behavior. And behavior is the most honest indicator a market has. Right now, behavior is cautious, defensive, unwilling to engage without guarantees. And markets don't thrive on guarantees. They thrive on confidence. When confidence fades, even strong fundamentals can't stop the damage. Good assets get sold, solid companies get repriced. Healthy balance sheets don't matter in a liquidity event. Everything becomes correlated to fear. That's the stage the system is approaching. Not because of one rejected offer, but because of what that rejection represents. A hesitation that shouldn't exist in a healthy market.